Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. We've spent a lot of time lately on the status and developments regarding the global macro. I thought in this session we might spend some time on what we do behind our technical analysis charts on the global macro analytics front. Hopefully you will see in the following charts this significantly impacts and contributes to how we interpret the technicals. As such, I hope to cover the following topics outlined here. By a specific focus on credit risk, along with liquidity and flows, I hope you will take away the fact that the control of the financial markets has critically shifted since the 2008 financial crisis. A clear understanding of how the controlling mechanisms of liquidity, flows, and credit creation needs to be developed and closely tracked to be able to make investment decisions and protect your investment portfolio from abrupt drawdowns. Hopefully, this will also assist you with your views on what to expect as a consequence in 2021, over the next 3 to 5 years, and for that matter, this decade. This diagram is on the opening page of the Macro Analytics section on the MetaSii.com subscriber site. Over the years, we've spent a lot of time explaining the linkages between the market areas shown. Most recently, we have been focused on yields. Prior to that, we focused on central bank liquidity and the global liquidity proxy. Prior to that, we detailed controlling flows in the form of many influencers, such as shrinking stock float pools. I encourage you to review some of the 650 videos we have produced since the 2008 financial crisis on our YouTube channel. We developed a macroanalytics technique that has been a moneymaker for us for 25 years now. It is shown here. It has kept us in, got us out, knowing when to go short or long. It is not something you can actually trade with because it is a longer term view, but it keeps your portfolio on the right side of the trend and avoids major drawdowns in your portfolio. We use leading indicators such as money flows, accumulation, distribution, and our proprietary momentum indicator to assist with early entry and exit points. What this analytic tells us is that the S&P 500 specifically may have a lot further to go to the upside. However, it is currently way ahead of itself and needs minimally to consolidate. That consolidation is likely to mean a touch of the red line, currently just below 3,800. Second is the fact that though markets are at record highs, market volume, as shown at the bottom, has steadily fallen. This is as strong a proof as anyone should need to then want to know what is going on and how long can this go on. Most importantly, the build-up to this particular analytic has shown us that since the 2008 financial crisis, the markets have become increasingly more controlled and managed. Microprudential policies such as financial repression, quantitative easing, yield curve control, etc. have been married to monetary and fiscal policies that are implemented in coordinated fashion to mitigate the damage of such destabilizing events as the EU crisis. Many will remember Greece, Cyprus, and the pigs, and the current COVID pandemic. We need to know the root cause to frame our investment perspective of what might lie ahead for liquidity, flows, and credit. The understanding starts with credit. I've simplified our gearing chart to point out that to understand what is going to happen in the equity markets, you need to start with credit, then the currency markets, then the sovereign bond markets, then finally, the most risky of all, the equity markets. Credit and currency are linked by an understanding of what wealth is and how it is created. It can't be printed, but must be built, grown, or mined. Wealth is collateral that credit is secured against and created by. Today, credit aligns with risk, which is most easily observed and measured by credit default swaps. CDSs support currencies and bonds, which themselves are linked by sovereign governments and central bank policies. Equities are theoretically based on discounted free cash flows and come with risk premiums and react to demand and supply. We might want to simplify this as simply 3 operating mechanisms. As part of our money chart for understanding liquidity, flows, and credit, we have tracked credit default swaps since their inception for select countries around the world. A specific representation and time frame is shown here going back to the EU crisis. It is the reason for the focus on EU countries at the bottom of the table. The chart is too small to read, so on the right I have exploded the view of what has occurred in the last year. You can see that credit default swaps rose in March of 2020 with the pandemic taking hold and have today fallen back. I think we can agree the COVID pandemic is likely the greatest global economic and social disaster to have occurred since the 2008 financial crisis. So let me ask you two questions. Why did the 2020 CDSs not rise to even the level of the 2012 EU financial crisis? In fact, not even close. Secondly, and much, much more importantly, is why, as shown on the left, have global credit default swaps fallen steadily and so dramatically since the financial crisis? The question is actually, how can risk insurance fall from $540 in Italy in 2012 to $84 today when the Italian industrial north is in near ruin from COVID? How can UK credit risks in 2012 go from $72 to only $10 today? How can German credit defaults in 2012 go from $101 to only $10 today? Something is wrong. This degradation is the same around the world. Quietly, credit risk insurance has become a fraction of what it used to be only 10 years ago, yet sovereign debt is at historic highs against GDP. What gives? When credit risk insurance is so cheap, you can take massive leverage risk and yet be protected for next to nothing. Obviously, central bank liquidity will rapidly turn into financial flows if risk protection costs border on being nearly free. How could this occur? Who is holding the bag? Many may recall it was insurance companies such as AIG during the housing debacle of the 2008 financial crisis. But this is about sovereign debt. As we are all well aware, central banks until recently had taken rates to the zero bound. So we have money almost free and the ability to protect against risk nearing the zero bound. What financial institution would not be forced to speculate or to be cannibalized by their competition if it doesn't? As an aside, I would argue that precious metals have also reached the zero bound as the spread between physical and paper has now become quite absurd. To answer what is going on here and maybe gain some insight into what lies ahead, we need to go back to 1980. Financial writers all cite August 1971 when President Nixon took the US dollar off the gold standard as a seminal event. Important? Without doubt. However, much more important was 1980, when as a result of its consequences and deteriorating U.S. economic conditions, the global balance of payments was changed. Up until that time, all global balance of payments had to be settled annually in the transfer of gold reserves. This settlement process was the purview of the privately held Bank of International Settlements in Basel, Switzerland. They did the bookkeeping, so net adjustments could be efficiently administered. There was no auditing of their books because all countries knew from their own central bank books what their net balance position should be, which would match the Bank of International Settlements books. However, in 1980, it all changed when it was quietly agreed that balance of payments would be settled in credit. This changed the world and, frankly, the underpinnings of the capitalist systems. It placed us on a road that can best be described as creditism, where credit has replaced savings, and investment in wealth-generating productive assets has been replaced by consumption. The 10-year U.S. Treasury note since post-World War II Bretton Woods has been adopted as the risk-free global benchmark. As you can see here, it has been steadily taken down in yield in a managed fashion since then. This is not too dissimilar to how credit default swaps have been taken down since the great financial crisis. Remember, as yields fall, bond prices go up. So it has created tremendous wealth for banks as the market makers in U.S. Treasuries. It has also created artificial collateral and bank assets to assist capital ratios. 1980 marked the departure of the U.S. from what can best be described as fiscal responsibility. Current accounts have steadily fallen, as well as the twin deficits of the government budget balance and the U.S. trade balance. But something else has also occurred. Today, we have $5.5 trillion in U.S. currencies traded daily. Additionally, we have $6.6 trillion in interest rate derivatives traded daily. These are gargantuan numbers. Though the global economy only approximates $84 trillion, we now have global interest rate and currency swaps valued at $559 trillion. What is going on here? How can this be? Well, let's focus on the words OTC swaps. OTC stands for over-the-counter. This means unregulated and private. Swaps means there is no sale, but rather an agreement to possibly exchange what is agreed to as being like for like. Sounds like a ticket to ride for potential unscrupulous actors to me. So who tracks all this? There is only one source, and that is the Bank of International Settlements, or BIS. Surprise, surprise. Though the swap agreements are all between two parties, the settlement of balance of payments is based on credit and accounted for by the Bank of International Settlements. This accounting nightmare is mysteriously all done in a single building in Basel, Switzerland, which, by the way, is the hometown for all global banking regulations known as the Basel Accords. It seems somewhat interesting that the country historically famous for its banking secrecy laws is home to these financial banking institutions. The same as central banks control interest rates and their currency creation, it is my studied opinion that the BIS now effectively manages or minimally significantly influences credit default swap pricing for sovereign debt and has since the EU financial crisis. Not far from Basel is Davos, Switzerland. Davos is the home of the World Economic Forum with its annual meeting of the global elite and now the spearhead of the Great Reset. I did a full Under the Lens video on the Great Reset in December, which I encourage you to review if you haven't already. The Great Reset is a significant and well-coordinated effort to change the world towards what the global elites, with political power and corporate control, feel needs to occur. It is my conclusion that they believe that threatening global problems such as those listed here are now a forcing function, requiring a significant change. They see the U.S. as no longer the unipower it once was, as illustrated in the diagram in the bottom right, and is in economic decline, which threatens global consumption demand run rates. Additionally, it exposes the long-running concerns about the value of the U.S. dollar that their wealth is predominantly valued in, the dollar's role as the global reserve currency, and the U.S. Treasuries as the global risk-free benchmark. China, since the 2008 financial crisis, has officially reached the position of being a global superpower, and with it everything that it entails. You need to appreciate that China does not participate with the other central banks at the quarterly BIS board meetings. It is not invited, and I'm told by people with an understanding of these matters that China has no interest in participating. How can powerful countries like China and Russia operate separately in an ever-increasingly interdependent global economy? Therein lies the rub. Since the 2008 crisis, China has increasingly become a major influence on real rates, not the central banks who control nominal rates. We have discussed the Chinese credit impulse rate extensively over the last year, as well as Fisher's equation on nominal and real rates. We have colliding, controlling influences. As credit defaults and bond yields run out of runway at the approaching zero bound, China's control of the real rate through credit is usurping important controlling power. This has profound implications. The Chinese impulse is driving real rates up with a 12-month lag and is now signaling a major contraction in Q4 of this year, as you see in this chart. The credit impulse is now reversing to the downside. With China controlling and driving global supply chain and their commodity price inflation, the Basel and Davos elites have a challenge on their hands. Global central banks appear to be caught in a trap of either allowing an asset bubble to grow and inflation blowing out of control, or destroying the dollar and imploding an artificially over-leveraged credit edifice. Some important decisions are going to have to be taken between now and the end of Q3. As they are normally, the pressures are likely to be as a result of market actions. The red arrow at the bottom right says that our long-term cycles are soon going to take control from either one of these players. China is only too aware of the power shift at stake and can be counted on to have a well-crafted plan. The developed economies, on the other hand, seem trapped with no plan. It is my opinion that the Great Reset is not such a plan. There are huge problems ahead. We have outlined these problems in prior videos and this year's thesis paper. We encourage you to read the current thesis paper entitled Social Suppression. It suggests what the powers to be will be forced to do. On the MATA SII subscribers main login page, there is a link to over 80 real-time charts that specifically focus on the drivers currently at play in what we have described here. This, along with over 160 securities charts in the Strategic Investment Insights section and index charts in the Trigger section, are all required reading to follow this unfolding macro-analytic mechanism. As I always remind you in these videos, remember, politicians and central banks will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. The powers to be are now effectively trapped by policies of fiat currencies, unsound money, political polarization, and global policy paralysis. I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments often are, there has seldom been a better time for investing. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. So until we talk again, may 2021 turn out to be an outstanding investment year for you and your family. And I sincerely thank you for listening.